Hello guys, so in this session, let's try to talk about or discuss one of the most informative reports which is published quarterly by JP Morgan Asset Management. And this report again, it's a publicly available report. Okay, it's not something I've tried to pick up privately or from the sources which aren't available in the market. Again, it's a publicly available report. एंड दिस रिपोर्ट इज समथिंग विच नॉट एवरीबडी नोज अबाउट इन द मार्केट कि भाई एक ऐसी रिपोर्ट भी एग्जिस्ट करती है एंड वहाँ पर वी कैन हैव द अंडरस्टैंडिंग अबाउट द ग्लोबल मार्केट्स पर से राइट एंड एवरी टाइम आई हैव बीन स्ट्रेसिंग every time to all my students and all the audience who are watching this video or all my videos or all my sessions, I always suggest them to develop a global market view. Understand that we get a lot of like information upon the Indian markets, right, on daily basis. What's happening in the Indian markets? We get to know about the valuations, how are the global markets impacting the Indian markets. But one thing also which is very crucial is to understand the global markets and the different countries as well. What's happening in, I would say, like major developing economies and the major emerging economies per se, at least. तो उनके बारे में भी थोड़ी सी इंफॉर्मेशन होना इज वेरी क्रूशल. Correct. So again, see, what basically happens is if you're planning to build up a career into equity research, into investment banking, into investment specialist, fixed income research profiles, consulting profiles, it's not always mandatory that you will get a profile or like you will get an opening for the Indian companies only, or Indian equity research roles only, or Indian investment specialist research only, or Indian portfolio manager roles only. You might get some exposure to do research upon Japanese companies, upon US companies, upon China equities, upon the global equities, right? And similarly with the global fixed income as well. So there are multiple ample opportunities in the market. And that is why I always insist to all my students that do not restrict yourself only towards Indian markets. Have a basic understanding, start your journey from the Indian markets, have a good understanding about the Indian markets. But once you believe that you have a fair, decent understanding about the Indian markets, that how the Indian macro works, how the global macros impact the Indian markets, right? The price to earning multiples, the PB multiples at the index level, at the company level, making one sector as your favorite sector. Try to have an opinion, try to have a view upon the global markets as well, global companies as well. What's happening in the developing markets, what's happening in the emerging markets, right? So at least have a macro view as well as a micro view. And this report is something that will give you at least a superly advanced view from basic to advanced upon the major developed economy as well as the major emerging economies as well. Correct? So this report is something which is available on a public platform. It's a 71 pages report. We'll try to figure out the most important pages of this report, try to decode a few of the things, try to understand some things conceptually as well, and try to learn some new things also, which we do not learn in traditional investment banking courses, which we do not learn in traditional equity research courses, investment specialist courses. And we only learn these things once we land into such kind of profiles practically. So this report, that's the guide to the market. It's the latest available report. It's the latest available report. They're guiding you what might happen in the second quarter of 2026. So in the global markets per se, especially US, the calendar year is followed. The fiscal year is not followed. So as in India, we tend to follow a fiscal year, right? Which begins from the 1st of April 2000, like for example, FY26. FY26 like just got ended. It began from 1st April 2025 and ended as on 31st March 2026. But in the global markets, especially the US markets, they tend to follow a Jan to December ka calendar. That is 1st Jan 2025 to 31st of December 2025. So in 2026, the first quarter has gone already. They have entered into the second quarter. So this report is the latest report published as on 31st March 2026. Now, just to give you a brief background, this report will give you a view of what happened in the previous 12 months or the historical data for the global equity markets as well as what's looking forward. What is the expectation going forward based upon earnings, based upon market cap breakdown, based upon the P multiples as well, right? So let's try to understand the report. I personally understand it's not important to go through every page. Let's try to decode the most important pages. This is the management. Again. If I recommend or like if I talk about like any of the stocks, right? Or if I talk about any of the markets per se, or this company which has published this report, It doesn't mean I'm giving you an advice to invest into this company's report, into this company, or into any of the companies or countries of which I talk about. All the discussion that we're going to have right now is just for education purpose, informative purpose, to make you understand things practically. Always consult your investment advisor to make a decision. And again, if you are liking, if you are trying to understand, if you really believe that you guys are getting something new out of these videos, do like and subscribe the platform and press the bell icon to get the latest continuous updates. So let's get back to the video. Now, if we see the S&P 500, so the S&P 500 is the major index of US, correct? अब यहाँ पे if we see is trading at a forward PE of 19.7 times. The 1 year forward PE is trading at 19.7 times. It's coming closer to the fair valuation territory. The average multiple or the average historical multiple on a 10-year, 20-year basis for the S&P 500 has been somewhere closer to like 16 or 17. 1 year back or like 6 months back, this multiple was trading above 22 times. Though historically, one trend that we can see is, right, the Indian markets and the US markets, though we tend to say have a less correlation, though the correlation is not completely negative, but the correlation is less. They are not perfectly correlated. They tend to have a weak correlation of between zero point 0.3 to zero point 0.4, right? But not negative correlation. But as we see in the case of multiples, in case of the price to earning multiples, like traditionally we have seen from a valuation perspective, not from a portfolio construct perspective, but from a valuation perspective, the multiples of both the Indian markets as well as the US markets, they tend to have a strong positive correlation, right? So as of now, if we talk about the Indian markets are trading at a 1 year forward multiple of closer to 18.5 times or 18 times price to earning multiple. And in the similar trajectory, the price to earning multiple of the US markets have also come down towards a closer territory. Now, here I understand the other markets have also corrected because of the US Iran war. But the relationship or the linkage within which the US multiples in terms of valuations and the Indian multiples in terms of valuations tend to move is much more higher vis-a-vis the other markets per se, right? The This is the forward PE. The dividend yield is 1.6%. The 10-year treasury is trading at 4.3% as on 31st March 2026. At the day I'm shooting this video, this number might be different, or this multiple number might also get changed if the market corrects a lot, right? But as of now, as on 31st March 2026, the 1 year forward price to earning multiple has been 19.7. Again, we have talked about what exactly is the price to earning multiple. We have talked about the trailing price to earning multiple, the forward price to earning multiple. We have also talked about what's a 10-year treasury is the risk-free rate which a 10-year government bond or a 10-year treasury bond commands in US, almost risk-free. Not completely, almost risk-free. Because there is always a reinvestment risk, a mark-to-market risk, be it any kind of a bond, right? We go forward. The 30-year average of the price to earning multiple is 17.2 times. S&P 500 is currently trading at a 1 year forward multiple of 19.7 times per se, right? But the 30-year average has been 19.7 times. Again, 30-year average is too far behind because every 10 year, every 5 years, the markets tend to change, right? The current dynamics of the markets are far more different vis-a-vis the before 10 years or the previous 5 years, right? After COVID, the global markets or I would say the global markets in the context of both the developed markets as well as the emerging markets got changed in terms of the structural dynamics, in terms of inflations, in terms of macros and different dynamics, right? The cap multiple or the Shiller's PE. The Shiller's PE, it currently stands at, right, 32.7 times, but the average has been 28.7. So based upon the Shiller's PE, the cyclically adjusted price to earning multiple. What is a CAPE? C stands for cyclically, A stands for adjusted, and P is the price to earning multiple. So the cyclically adjusted price to earning multiple, which is also called the Shiller's PE, it currently stands at 37.2 times. The average tenure has been 28.7. So we can have a separate session upon trying to understand the cap multiple. But what exactly is the cap multiple? Just to give you the basic connotation. If we talk about the price to earning multiple, we know क्या होता है. It takes into account the current market price in the numerator and divides it by the trailing 12 months earning per share. The current market price in the numerator divided by the trailing 12 months earnings per share in denominator. What happens in case of the cyclically adjusted price to earning multiple? The numerator is the same, the current market price. The denominator is also the same, but just some minor twist is there. In terms of EPS, you tend to adjust the EPS with the inflation. That's an inflation adjusted EPS. So, for example, if the EPS in my current year, for example, if the EPS of the company has grown by 10%, correct? If the EPS in the past 12 months has grown by 10%, again, this is a hypothetical example. The inflation has risen by 3%. So 10% minus 3% is my inflation adjusted EPS. And the same I can do in terms of numbers also. The similar adjustment can be made in terms of numbers. So what basically happens in the case of the price to earning multiple, correct? If 10 was my EPS earlier, if 10 was my non-adjusted, non-inflation adjusted EPS earlier, in case of the price to earning multiple, when I adjust my 10 rupees EPS or a $10 EPS with a $3 worth of inflation, it's a 10 minus 3. So now my adjusted inflation or inflation adjusted EPS is not 10, it's 7, because 10 has been adjusted against a $3 or a 3 rupee worth of inflation. So hence my EPS is the smaller number now. My base has become a smaller number now, right? And hence my price to earning multiple, hence my price to earning multiple will magnify. It will be a bigger number now because of the lower base. Correct? So that is the cyclically adjusted price to earning multiple. That is, you are adjusting the earnings, you are adjusting the earnings against inflation. You are adjusting the earnings, the EPS in denominator against inflation. Now again, like what basically happens, if you are taking into account a trailing 12-month EPS, or for example, if you are taking into account a past 5 years EPS, every year's EPS need to be adjusted against inflation. Every year's EPS need to be adjusted against inflation, and then that adjusted number is taken into account, right? So for example, if I want to know, okay, if I take in, for example, if I take in denominator the 1 year past EPS or a TTM EPS, okay, so that non-inflation adjusted EPS, till this point of time, I have not adjusted my EPS against inflation. I'm yet to adjust my EPS against inflation. So to adjust my EPS, I'll have to take into account the consumer price index level, the consumer price index level in the base year, and the consumer price index level in the current year. So if my EPS is 10, I'll be multiplying that by the consumer price index in the current year divided by the consumer price index in the base year, right? So maybe like since we are on that, I can just show you one thing as well, if you don't mind. Maybe I can just share my screen with you and let me just share the screen. So here comes. So here comes the formula for the cyclically adjusted price to earning multiple. So that is your current market price divided by the average inflation adjusted earnings over 10 years. The same number can be taken for the past 5 years also. Correct. In the formula that we saw in on the screen at the JP Morgan report, it was for past 30 years. So what basically happens, we are taking into account the current market price of the index in the numerator, or the current market level of the index or the stock price in the numerator. And then we divide this by the average inflation adjusted earnings over 10 years. Average inflation adjusted earnings over 10 years. Correct. We can have a separate video on that how to adjust these numbers as well. Again, that's a good thing to ponder upon. Again, coming back to our report, this is our report. The current dividend yield is 2%. The earning yield spread, the earning yield minus a bond having a rating of Baa. This currently stands at minus 0.3%. The 30-year average has been 0.7%. It means the bond are giving you a better yield vis-a-vis the earning yield at the benchmark level, right? It means the earning yield of the equities have collapsed or beginning to collapse at the index level, but the bond yield is giving you better income or better returns versus the S&P 500 as of now at the index level. The hyperscalers being a magnificent 7 or a magnificent 10 might be the outliers, but at the index level, a BAA bond having a credit rating of Baa is giving you a better yield vis-a-vis the earning yield, which is the inverse of the price to earning multiple on the S&P 500, right? Which is 1 by 19.7. 1 divided by 19.7 in this case. In this case, it is 1 divided by 17.2. Now, this is a regression chart. This is basically telling you, though I won't be able to cover all the charts, right? But at least to cover the most important slides per se. So this chart is basically telling you key based upon the current price to earning multiple, right? Or the forward price to earning multiple that is based upon a 1 year forward price to earning multiple, right? How can we predict the 1 year subsequent returns? That is based upon 31st March 2026. On 31st March 2026, we have calculated 1 year forward price to earning multiple. So based upon that multiple, which is calculated as on 31st March 2026, what can be the 1 year subsequent returns for the S&P 500? And the same can be done for Nifty 50. The Shiller's PE can again be calculated for Nifty 50 as well, right? So based upon this chart, so it's basically telling you the lower multiple you enter into. At a lower price to earning multiple you enter into, higher is the expected return. This graph for the valuation is going down. So currently we stand at 19.7, like for example, correct? So as we go down the valuation, the expected future return, it begins to magnify. Because here, if you see, if you go at a higher valuation, if you're going at a higher valuation, the expected return would also be low. But if you're entering at a lower valuation, the expectation of the 1 year subsequent returns will also be high. Correct? And that is the regression chart or the regressed chart. And here you can get the interpretation also. Correct? These charts demonstrate the historical relationship between the forward price to earning multiple and the subsequent 1 year and the 5 year returns. The slide shows that starting valuations have greater predictive power over the longer periods of time. The lower the valuation you enter into, the higher is the 1 year, 2 year, 3 year, 4 year, 5 year subsequent return upon that particular index. And the same can be done for Nifty 50 also. S&P 500 growth in 2026 again expected to be 16.6%. Again, that is fine. Here, like this chart is important. And also, like this is also important. If you see the past 25 years, in the past 25 years, the average growth in the S&P 500's EPS, the earnings has been 7.6%. But we are expecting 16.6%. Again, this number might be corrected by a few basis points due to the US-Iran war, right? But I believe the expectation has been taken into account already because the war started as on 28th Feb. So this is the expected revised number as it is, right? So the US market again is expected to grow at a higher EPS CAGR over the past 25 years. Again, all these are US based numbers, USD numbers. S&P 500 profit margins, right? In the 4Q, the fourth quarter, the October, November, December, the profits margin, the PAT, the bottom line, they grew by 14.1%. The next slide, again, is a very important slide. It is telling you the valuations of the top 10, 500, right? The S&P 500 minus top 10, that is the 490 companies, and the S&P 500 on a 1 year forward price to earning multiple. The current 1 year forward price to earning multiple for the top 10 magnificent 10 companies, it trades at 23 times. The average is 20.8 times. The 490 companies, it currently trades at 18 times. The average is 15.9 times. Correct? Here also, the S&P 500, it currently trades at 19.7 times. But the average, this is the 1 year forward multiple. The latest section, the latest column that you see is a 1 year forward price to earning multiple. So S&P currently trades at 19.7 times. Correct? But the historical average says 16.8 times. Weight of the top 10 companies. Now, weight of the top 10 magnificent 10 companies, ideally, in terms of market cap and earnings. In the S&P 500, they are having a 37.9% weight in the S&P 500 from a size perspective, from a market cap weight perspective. But from an earnings perspective, they have a 33.2% weight. From an earnings perspective, they have a 33.2% weight. Again, it's an important chart. You see the returns of the, right, the S&P 500, correct? You see the S&P 493, that is excluding the Magnificent 7. The returns in terms of the price performance, not the earnings, but the price performance, It peaked somewhere in 2021. And from there, the returns have come down or have become flattish. For the Magnificent 7, see, it peaked at 40%. It peaked at 40%. We are down to 23% as of now. 2026 YTD, Jan to April as of now, it stands at negative minus 11%. S&P 493, it peaked at 23%, again down to 13%. The below chart shows the year-on-year earnings growth. This table shows you the price performance. The below table is guiding you upon the earnings per share, year-on-year earnings growth. So we can see the spread in the earnings growth of the Magnificent 7 as well as the S&P 493, excluding the Magnificent 7, is converging now. Earlier in 2021, the spread was very high, correct? In like 2021, barring 21, if you even start from like 2023, the spread was high. 24, the spread started to narrow a bit. In 25, it narrowed once again, correct? Again, for the full year, these estimates might change because it's just the start of the year. In the actual numbers, as we see in 2025, the CY25, the earnings spread or the EPS spread between the Magnificent 7 as well as the S&P 493 is getting compressed. Now, this is the Magnificent 7 performance dispersion. NVIDIA being the maximum in terms of the price performance, followed by Meta, Tesla, Amazon, Alphabet, Microsoft, Apple. The S&P 500 stands there below. Large companies by size. Again, I can attach the link of this report in the comment section. Right, you guys can view it. बाकी चीजें you guys can have a thing. Again, this is something you can watch upon. S&P 500's earning growth by sector, tech being the maximum one. Again, this can be something. Here they have a comparison between the Russell 1000 growth and the Russell 1000 value. The long-term average for the Russell 1000 value has been 14.3. It currently stands at 16.3. And again, for growth, the long-term average for the Russell 1000 growth has been 21.5 times. It currently stands at 24.1 times. So both the value index as well as the growth index trade at a higher valuation multiple. Correct? So that is something we got to know. Here we can see much of the value sectors, correct, are bound to give the next leg of growth. Correct? So tech is more of a growth theme now, or large cap. Correct? Energy sector, it's a value theme. Industrials, again, a value theme. Materials, again, a value theme. Consumer staples, healthcare, the real estate, financials, consumer discretionary, all are value. Again, also like one more thing I will tell you. Thing is, in India, we usually say, or we always say, the large caps in Nifty 50 are value companies, right? So much of the growth companies shall come, or like much of the growth is possessed within the mid cap space and the small cap space, correct? Right? But in US, the philosophy is completely different as of now. The large caps being high growth and high risk, whereas the mid cap and the small cap spaces are the value themes. I'll repeat my point. In Indian context, the large cap companies, the Nifty 50 or the Nifty 100 per se, are categorized as value companies. That is, less growth companies, and being, I would say, resulting into a lower risk as well. And the high growth segment is within the mid cap space and the small cap spaces. But if we talk about the US markets, the high growth segment, accompanied with higher risk, it comes up in the Magnificent 7 or the large cap companies. But the lesser risk is there in the mid cap and the small cap companies. So much of the theme that you see in here, barring tech, which is a large cap growth theme, energy, industrials, materials, consumer durables, healthcare, financials, especially, they belong to the mid cap and the small cap spaces. The mid caps and the small cap spaces are the value spaces in US, and the large cap spaces are the growth spaces in US. And in India, the story is completely opposite. The next slide, if I go on, this is again a very important slide. Median S&P 500 25-year average has been 16.3. Again, it is not average, it is median. I've told you the difference between median and average always. Focus upon median price to earning multiple. The current stands at 18.5. The valuation spread was 11.8 and the current valuation spread is 15. What does this chart tell you? The valuation dispersion. Dispersion between the forward price to earning of the S&P 500 stocks in the 20th and the 80th percentile. So what does this chart basically tells you? It is basically telling you So what's happening in US? In US, the valuation dispersion between the stocks in the 20th percentile and the stocks in the 18th percentile has increased from 11.8 as a 25-year average to 15 now. The valuation dispersion between the stocks in the 20th percentile and the 80th percentile has increased. The past 25-year average has had been 11.8 and the current number being 15. What do I mean by that? In the 20th percentile, you have cheap stocks or value stocks, the mid cap stocks, the small stocks, the small cap stocks belonging to the consumer staple space, the material space, right? Hospital space, energy space, the metal mining space, the real estate space. Whereas in the 80th percentile, you have high growth companies, the Magnificent Seven, for example. Correct? So if the valuation dispersion or the valuation spread between the 20th percentile and the 80th percentile starts to increase, it means the trades can mean revert or the trades can become opposite. As of this particular point of time, we can see the Magnificent Seven or the growth stocks in the 80th percentile are already enjoying a growth momentum. Their valuations have become exorbitantly high, though they have corrected as well. But in comparison to the value stocks in the 20th percentile, which are still so cheap, and the recent US-Iran war has made them more cheap, right? The valuations have again come down, right? The value stocks in the 20th percentile were already trading at a very low valuations, and that is why these 20th percentile were named as the value stocks. But now, during this war, the valuations have further corrected and they have become much more palatable or much more reasonable to invest into despite their lower valuations earlier as well. So, when this valuation spread tends to increase between the 20th percentile stocks and the 80th percentile stocks, it means the money can shift from the growth stocks to value stocks now. And the other sectors like the energy or the consumer staples, not consumer discretionary. Your consumer discretionary is not a theme in US, it's a theme in India, right? Your industrials, materials, consumer staples, healthcare, real estate, financials can perform really very well, right? Percentage breakdown. So here you see again is a very important chart. The majority of the sectors you see barring the tech sector, right? This gray or black is the large cap. This green is for the mid cap. The blue is for the small cap. Correct? Barring the infotech sector, the tech sector, which has most of the weightage in the large cap. All the other sectors, be it financials or communication services, में थोड़ा ज़्यादा है. But be it like financials आप देख लो. Financials has majorly in the small cap. You see consumer discretionary, you see healthcare, and you see industrials, you see consumer staples, energy, the utilities, materials, and real estate. Much of it is encapsulated within the mid cap and the small cap spaces, right? And here, if you see the forward P is much more attractive for the mid cap space, standing at 17 times. The small cap trade at 23 times because of high growth in nature, and the large cap stand at 20 times. The interest coverage ratio is maximum for large cap spaces. Maximum small cap companies are unprofitable. Maximum downward revisions are being made in small cap companies, right? The number of analysts per company in the small cap is the least, correct? But in India, the story is opposite, right? The structural composition or the P&L or the balance sheet or the cash flows of the small cap and the mid cap companies are very strong versus the US companies. In the US, the mid cap and the small cap sector is seen with a second eye, is seen with, I would say, doubt or skepticism, right? Because their balance sheets, their P&Ls and cash flows aren't so strong. But the mid cap and the small cap companies in India, their balance sheets, their P&Ls and cash flows are very strong. If you see the small cap companies, their net debt is almost zero. The gross debt stands closer to zero point 0.1. Their cash flows, the CFOs to EBITDA ratio is more than 100% now. They're standing at 115%, 1.15 in case of the small cap companies. The mid cap and the small cap companies being structurally very strong in case of India, but not so in US. Again, like this is something that you can read. Like similarly with this, based upon different sectors and returns. Again, this is something that you can read. It says, and the similar chart we have for Nifty 50 also, right? That despite the average intra-year drops of 14.2%, average annual returns were positive in 35 out of 46 years. Again, this is the GDP contribution maximum coming from consumption, same as India. In India, the number is 61.5%. In US, it is 68%. Again, this is the payroll number. right? The average wage growth in the 30 years has been 3.4%. Like currently it stands above at 3.7%. The average unemployment rate for past 30 years has been 5.5. We currently stand at 4.4. But again, this number has been increasing, and that's a problem in US. The wage growth has been declining, and the unemployment rate was somewhere closer to 3.8, 3.9% last year. It has edged up to 4.4% now. Again, a problem. George's opening, you guys can see that. Spend some time upon the slide based upon expenditure. Again, the CPI numbers you guys can have a go through. Same with this index. Same with this index. Again, this chart is also very important, especially the right-hand chart. So this chart is basically telling you the US trade balance in the 4Q25, the current account as a percentage of GDP. The current account deficit was 2.4%. And the second chart is the developed market interest rate differentials and the dollar, right? Difference between the US 2-year yield and international 2-year yield. Difference between the US 2-year treasury bond yield and a basket of other international markets trading the 2-year bond yield. So this status basically tells us that over a short-term period, in US I'm talking about, over a short-term period in US, right? Over a short term, it's impacted by the interest rate differential. Over a short term, the US market is impacted by the interest rate differential. Why? So, for example, if in US the interest rate is 4%, but whereas in the other countries the interest rate is 2% or 1%, then people will buy the bonds in US. They will sell off their home currency and buy the bonds in US. And to purchase the bonds in US, they have to purchase USD and sell their home currency. The demand for USD will rise and hence the dollar will become stronger. In the shorter term also, the dollar will become stronger despite the current account being negative because of this interest rate differential, because of the USD being the reserve currency, because of 60% of the global trade being done in USD and multiple different factors. Correct? But if we talk about the US trade balance, in a short term, the current account deficit will not impact much. But over the long term, this current account deficit will have an impact. And this will drag the USD to become a weaker currency. And this will drag USD to become a weaker currency because a higher current account deficit, it weakens down your currency as happens in case of India as well. Though we have significantly improved our condition over the past 2 to 5 years, but the same is there with every country. So the current account deficit as a percentage of GDP will not impact the currency over a shorter term tenure. But the current account deficit as a percentage of GDP will be impacting the currency over a long term basis. But over a short term basis, the interest rate differential impacts your currency. But over a long term basis, the current account deficit impacts your currency and not the interest rate differential. You might be having a higher interest rates over the long term vis-a-vis the other markets. But a longer current account deficit, if it persists and if it increases, will hamper your currency because you shall be importing more. You shall be importing more. And to import more, you shall be selling of USD. You shall be selling of USD and then purchasing. Correct? But like what basically happens is much of the trade is being done in USD, right? Much of the trade is being done in USD. That is the reason why still USD being the reserve currency and being a stronger currency, right? But ultimately, over a long term, if the fiscal deficit increases, the US debt burden continues to rise, which is a problem as of now, servicing $1 trillion of interest every year, and the current account deficit also increases. So over the long term, the currency will adjust automatically. If you see on the right hand side, the top right chart shows the current account balance of the US as a percentage of GDP. A stronger US dollar tends to lead to a larger current account deficit in the shorter term. In the short run, the US dollar is driven largely by the interest rate differentials as we talked about, as shown in the bottom right of the chart, which compares the 2-year US Treasury yield to a basket of 2-year yields for each major trading partner and the dollar index. Over the long run, the US trade deficit should cause the dollar to decline, right? Again, this you can have a look on. This again you can see average tariff ठीक है हमें पता ही हम देख लेंगे. This you guys can have a look upon. Rising gasoline prices and the oil prices, you guys are aware about what's happening in the global markets. I won't stress much upon that. Here you get the correlation, right? of the US treasuries for different maturities vis-a-vis the 10-year bond and the S&P 500, right? Tips being the treasury inflation protected securities having the maximum correlation. US aggregate is also having a higher correlation versus the 10-year government bond. Why? Because the 10-year government bond is almost risk-free. And the second category of safer instruments are the corporate US aggregates or your investment grade bonds by corporates because they're also safe, not as safe as the government, but the default risk is less, right? Vis-a-vis a high yield, right? Which is too risky. So US aggregate and IG corporates, they have a closer correlation towards the US 10-year, where convertibles will have a higher correlation towards equities because they will get converted to equities. Even your US high yield will have a higher correlation towards the S&P 500 and not the 10-year because US high yield is a risky instrument and equities are also risky. So hence the US high yield will be having a higher correlation with the equity markets. 0.79. Convertibles because they will get converted to equities later. That currently they are the fixed income, correct? So again, this fixed income will get converted to the S&P 500. The municipals, again, they are safe. They're safe assets. Hence, a higher correlation with 10-year. Mortgage-backed securities, they have a highest percentage. Second, after your investment grades, after your government securities in the Bloomberg Barclays Corporate Index, correct? So once again, they're the secure ones. Leverage loans has a negative correlation. Again, it can be a good asset diversifier in a portfolio, correct? पर हम आगे बढ़ते हैं फॉरवर्ड कर्व ठीक है ये आप सब पढ़ लेना दिस इज अगेन इज इंपॉर्टेंट यू सी द इन्वेस्टमेंट ग्रेड स्प्रेड्स हैव कम डाउन corporate credit spread is simply the difference between the corporate bond yield and a government bond yield. If a corporate bond spread is rising, it means the riskiness in the US markets are rising, right? What's an option adjusted spread OAS? A separate video is there on YouTube where I've explained you the different types of spreads. Z spreads, option adjusted spread, spread to worst. All these things have been talked about. Watch that video. But just to tell you in nutshell, the corporate spreads or the corporate, I would say the credit spreads is simply the difference between a 10-year corporate bond or a 2-year corporate bond minus a risk-free government bond. If this spread is wider, if this number is higher, it means the risk in the market for that particular category of bond is high. The average spread has been 145. We currently stand at 89. High yield bond is the most riskiest category, which invest into lower tier grade securities. The spread had been 502. We currently stand at 317. It indicates no risk or a very, very lower risk as compared to historical averages in the US markets. The yield to worst has also become low at 7.4, right? We go ahead. Hyperscalers का net debt कम हो रहा है, that's fine because even if they're taking up huge investments, the US IG का debt is 2.6 times your debt to EBITDA, net debt to EBITDA multiple. The lower it is, the better it is. It means your EBITDA, your earnings before interest and tax, depreciation, amortization is a higher number versus your net debt. This number should be as low as possible because EBITDA should be higher, your profit should be higher, your cash profit should be higher. Correct? So hyperscalers, the Magnificent 7 or the Magnificent 10, despite their higher capex investments as on 31st March 26, still trade at a very, very, very low debt to EBITDA, net debt to EBITDA multiple. Tech spreads are wider than the index. Tech spreads, tech sector spreads minus the overall index spreads. Correct? So basically, the spread, okay, it means your riskiness in the tech sector is becoming higher. When the spread is rising, correct? When the spread is rising, it means your tech sector is becoming much more riskier, like vis-a-vis the index. The same is mentioned here. So again, you can understand this concept of a Muni tax equivalent yield curve, right? It's very important. Maybe we can cover a separate video on that. Again, it's a very important concept in US. Understand yield to worse. Again, a specific video is there on the YouTube to understand yield to worse on my channel only. Refer that. And again, if you are still with me in this video, being a longer video, and you're liking the content, do subscribe and press the bell icon to keep me motivated to come up with such new informational videos. Fixed income at the treasuries in the Bloomberg Barclays Index, right? The maximum weightage is given to treasuries, then the agency mortgage-backed securities, as we saw in, and then the IG corporates. The correlations, right, of these fixed income securities in these markets versus the correlation to a 10-year bond. Japanese being the closure one, but the rest are far away. Right? Good for diversification. These are the returns that you can check. This is the region-wise valuations at which the companies are trading. This is something which I want you to understand. So basically what happens, if we try to decompose the returns of any of the country, if we try to decompose the returns of the stock market performance returns for any of the country, they can be decomposed into four factors. The return can be decomposed into from earnings, the EPS, the multiple expansion or the contraction, dividend yield, and the currency return. Correct? So historically, if we see the 15 years annual average, the US markets and the Japanese markets have been driven much more via the earning growth, and all these numbers are in USD, and less by the multiple expansions or the currency movement. The Eurozone has been much due to the dividends, right? Correct? And the same if you see in case of China also, it has been more due to dividends. In case of emerging markets, it has been a combination of both dividends and multiples, but multiples slightly higher than the earnings. And this is a 15-year annual average. What happened in 2025? In Eurozone, the maximum earnings were driven by the currency return as well as the multiples. The Eurozone, it appreciated by 12 to 13% against the USD. The Euro markets enjoyed a huge currency return because of appreciation, and that got translated towards the Eurozone equity market index as well. The EM market, it was a major story of earnings, right? Earnings, barring India. In China, it had been a major story of multiples. The earnings were closer to negative. Japan had been a story of both the multiples as well as earnings. The US markets again earnings despite the higher valuation. What's the outlook in 2026? The Japanese market, it needs to be more of earning driven. The EM market, again, more of earning driven because the valuations have corrected a lot. The Eurozone being more of earning driven. The US, again, more of earning driven. China, earnings being negative and the valuations being negative. And that is something we need to understand, that how a country's return can be broken down into four parameters: the return due to multiples, the returns due to currency, the returns due to dividends, and the returns due to earnings. Again, this can be checked. I think we're good to go. The rest can be viewed by you on your own, right? In US, a 60-40 portfolio is very famous, right? It takes a 60% into equity, being the global equities and US equities, and 14 to debt. That's the fixed income, the global fixed income. And over a rolling returns, if you see rolling daily returns from 1989 for 10 years basis, over a 10 years, a 5-year, 3-year, historically, the 60-40 portfolio has outperformed the S&P 500. Also, if you see the global performance in terms of the annual returns, the S&P 500 giving you the highest performance, followed by 60-40, then gold, and then the US aggregate. But in terms of risk, the volatility of the gold has been highest in US, right? Versus the S&P 500, versus the 60-40, versus the gold, versus the US aggregate bond index. And why the volatility in the gold has increased? Because of the sudden spike in gold over the previous 1 to 1.5 years. If the sudden spike in prices is very high, there is a commensurate rise in the volatility or the standard deviations of the asset classes as well. And that is the reason that why the gold has become a riskier asset class in terms of volatilities, in terms of the standard deviations and the variances as well. Again, this can be decoded. That is fine. Here we end the report, right? Again, I think it was a very deep dive, a report to make you understand about the global markets, what's happening in the global markets and emerging markets from an equity level and the fixed income level. So see you soon in one more fresh video. And again, do not forget to subscribe and press the bell icon to get continuous updates on the financial news, products, and securities. Thank you so much.